Yes, 88 through to 98, those were the rules. We were aligned with income tax. And then Gordon Brown came along and he decided he didn't like any of that. And he abolished the link with income tax and reintroduced rates of tax effectively on capital gains tax, introducing tape reliefs, etc. at the same time. And then in 98, also indexation for individuals was abolished at that time. So now we're in a situation where real gains and inflationary gains are effectively taxed. At the moment, there are effectively 4 rates of capital gains tax. Typically, they are 18 or 20% on residential property gains and 10 or 20% on other gains. And what I thought would be useful to share with you some of the figures for who pays capital gains tax and what the quantum is. And the report refers to all of the figures for the 2017-18 tax year. Presumably because that's the sort of the latest year they had all of the info collected in. But it gives you a pretty good guide. So in the 2017-18 tax year, some 8.3 billion of capital gains tax was paid. And that was paid on net gains of just under 59 billion. But it was only reported by some 265,000 UK taxpayers. So a very small number of people compared to the general population paying capital gains tax. In fact, the comparative figure for 27-18 for income tax brought in 180 billion in that year, and that was paid by some 31.2 million taxpayers. So you can see there's a very smaller number of people paying capital gains tax, but there is a significant potential loss or perceived potential loss compared to income tax. If you took all of the gains that were charged in that year and instead charged them to the top rates of income tax, you would see there's potentially another 14 to 16 billion in tax revenue that could come in from those 265,000 taxpayers. So you can see why it's of interest to our dear friend Rishi, especially at the moment as the deficit grows ever larger. Ways of bringing it in or bringing that figure down are obviously going to be looked at in detail. And just to give you an idea of the breakdown of how those gains generally divide up, and again I've got the figures for 27-18, albeit I think this is a pretty good guide for how these transactions happen year on year. But out of that 59 billion or so of capital gains that there were reported on tax returns, maybe the two figures higher, some 28 billion of that was from unlisted shares. So shares effectively in private companies. The gains on that amount to just under half of all reported capital gains. Listed shares then, so that's people with portfolios, add in another 12 billion of gain. Residential property and foreign property, about 8 billion. Commercial property, just 2 billion of gains. Other financial assets, that include things like crypto, 5 billion. And then other non-financial assets, that's pretty much everything else, around about 4 billion or so. So you see the vast majority of the gains are really related to share transactions of one sort or another. And out of that 265,000 capital gains taxpayers in that year, 200,000 of those accounted for just 12% of the gains. So there's quite a lot at the lower end of the situation, and then equally there's a smaller number at the higher end. In fact, the top 2,000 taxpayers, and that's with gains effectively over 5 million, amounted to just over a third of the total gains. So the top 2,000 taxpayers had an average gain of just under 30 million each. So you can see why they might be looking at the rates and fairness here, that perhaps 2,000 people there are getting too much of an advantage with the low rates at the moment. So that's a little bit of the history and how the makeup of the capital gains works. But now let's move on to the actual report itself. The report itself lists in its 130 pages, and I did think about reading the entire report out, but we'll be here some time. So I'll just pick out the key bits. There are 11 recommendations within the report, and then you'll see as we go on, not all 11 could be implemented, some are options effectively, but it gives you an idea of the way future legislation may pan out. So recommendation 1 is more of a statement, really. It says, if the government considers simplification priorities to reduce distortions to behaviour, whenever you see that phrase, I think you can read that as reduce tax avoidance. It should either consider more closely aligning capital gains rates with income tax rates. It's going back to a situation that we had in 88, and Nigel Lawson did exactly that and just says that you will tax capital gains at income tax rates. Or if you don't do that and you keep the rate at some sort of single rate, then consider addressing the boundary issues as between capital gains tax and income tax. And obviously what it means by that is, well, look at items that currently are chargeable to capital gains tax and consider whether or not some of those should be chargeable to income tax. That's essentially what it's saying there. The two outcomes actually have, are similar in terms of the tax revenue, but it's really a policy decision as to which way they go. So recommendation 2 then goes on. Where's Charlotte gone? There we go. If the government considers more closely aligning capital gains tax and income tax rates, i.e. introducing effectively not a single rate for capital gains tax, but variable rates according to your income, then you should also consider reintroducing some form of relief for inflationary gains. Consider the interaction with the tax position of companies, and consider allowing more flexible use of capital losses. So what does it mean by that? And it starts off with making the point that I did earlier on. Within the report, it actually says that theoretically, if you aligned the rates with income tax, that you could raise an additional 14 billion a year for the exchequer. And this reflects the fact that the vast majority of capital gains by value come from higher and additional rate taxpayers. However, it is clear that nothing like this would happen in practice, because obviously the moment you put up tax rates, it affects behaviour, and it stops people from making disposals that cause the capital gains tax in the first place. So that's one of the issues that they are acutely aware of. Other challenges with a rate increase, you can get some odd situations. They talk in the report about one of the problems being what they refer to as the lumpy nature of gains, in that some people might, for instance, they own a second property and they sell that second property. That might be a one-off transaction for them in their lifetime. But obviously in that particular year, a significant gain can push them into the higher rates of tax. And in fact, it spends a couple of pages in the report talking about the possibility perhaps of some sort of averaging calculation to smooth out these situations. And the example it gives, it talks about a chap called Sid, and let's say Sid earns £30,000 a year. In the 2021 tax year, 12,500 of that, that's his personal allowance. So he pays tax at 20% on £17,500, and he's got 20,000 left of his basic rate band effectively unutilised. But if he makes a capital gain of £100,000, then the majority of that is going to be taxed at the higher rates, despite the fact that year on year he has been a basic rate taxpayer. So the suggestion is perhaps if he'd owned that property, say, for a 10-year period of time, to divide the total gain by 10 and apply the tax rate that would work on that. So in that situation, you take his 100,000 gain, he's owned it for 10 years, and you say, well, that's effectively accrued at 10,000 a year. he's still got 20,000 a basic rate band left, so we can tax the entire gain at the lower rate of capital gains tax. That's similar to what we've got at the moment on chargeable events and life insurance policies. It is a complex calculation, and to be honest, I'm not sure they're trying to introduce more complications at the moment. Nevertheless, it's in the report there for the Chancellor to consider. Indexation for inflationary gains would be an interesting one. It's trying to work out when they would do this from, but the essence here is that if you're going to align the rates with income tax, it seems manifestly unfair that any inflationary gains in assets that you own should be charged to income tax. So it's not a real gain, it's just by, the value of the asset has gone up by virtue of inflation. And that's why indexation was introduced back in 82, and unfortunately then got abolished in 98, but they're now talking actively about bringing that back. Now, that's in conjunction with aligning the income tax rates, so that the two sort of go hand in hand. What date it would start from would be interesting. I don't know. Later on in the report, they talk about a potential rebasing date, which I'll come on to. But inflation, say from the year 2000, which is mentioned later in the report, to current date would add approximately 70% to base costs, which would be significant. Whether they would just introduce it from the budget date in the future is unknown at this point, and there isn't a lot of additional comment around that area in the report itself. The interactions with companies is probably the sort of first major point, I think, of concern in the report, and the issue they talk about here is the differential between the way gains are taxed as individuals and the way gains are taxed in limited companies. It talks specifically about people who set up family investment companies, and they may do that for lots of different reasons, mostly centered around income tax planning. But there is little difference at the moment between the way gains are taxed within a limited company, because at the moment the rate is 19%. Right, we know that's going up in a couple of years' time to 25%, but at the moment it's 19%, and that's similar to the 20% rate that a lot of capital gains are paid at the moment. So there isn't a lot of opportunity really for avoidance in that situation. But of course, if you align the rates with income tax, and potentially you've got gains being taxed at 40 or 45% even, then there is a significant incentive to arrange your affairs so that you have your capital gains captured within a limited company, which it would pay at a much lower rate. And whilst it doesn't come really to a conclusion in the report, it simply holds out that there is that complication there from aligning the rates that would have to be looked at. The fact that they mention family investment companies rather than companies in general would suggest that is a target area for them. One good bit that it says is that you'd have, realistically, they would like to see a more flexible use of capital losses, and this on its own brings its own complications. If capital gains rate are aligned with income tax rates, then obviously capital losses become more valuable, and because there is often a significant choice in when you realise a capital loss, this could distort behaviour and amount to situations happening which perhaps were not anticipated. As an example for that might be if you've got a high tax liability one year and your stock market portfolio is in a bit of a slump, and you've got some shares sitting at a loss. You might have no intention of selling those shares whatsoever, but if you've got the opportunity to trigger a capital loss, which could be offsettable against income, then it's going to change people's behaviour in how they deal with their stock market investments. So these things are always difficult. Every time you create a new potential change in taxation, people are immediately looking for ways to make the most of it, shall we say. So capital losses are a difficult situation, but it is mentioned in the report that they should be more flexible. I think perhaps what might be more likely is perhaps the carryback of capital losses from year to year. At the moment, they can only carry forward. That would seem to be a reasonable way of dealing with it. But again, it does lead to distortions in behaviour, as they say, i.e. people actively making transactions to trigger a loss that they might not otherwise. So that's recommendation 2. Recommendation 3 is a bit of a strange one, I think. It says, if there remains a disparity between capital gains tax rates and income tax rates, i.e. you don't align them and you keep separate rates, and the government wishes to make tax liabilities easier to understand and predict, it should consider reducing the number of capital gains tax rates and the extent to which liabilities depend on the level of a taxpayer's income. What does all of that mean? It means having one single higher rate. That's obviously what it means. All this nonsense about it's easier to predict. Well, we know what the capital gains tax rates are in advance, so I can pretty much predict what rate of tax they're going to be at. And generally speaking, they're taxed at the higher rate. So this seems to me to be a prelude to just saying, well, we need one higher rate, and justification being put into the report that really doesn't stand up to scrutiny, I don't think. Recommendation 4 is when it starts to get a bit more interesting, and again, it sort of shows the target areas that they are looking at. They say if the government considers addressing capital gains tax and income tax boundary issues, then it should consider whether employees and owner-manager rewards from personal labour, as distinct from capital investment, are treated consistently. And in particular, consider taxing more of the share rewards arising from employment and accumulated retained earnings in smaller companies at income tax rates. Now, bear in mind, this recommendation is on the basis that they look at the boundary issues, not the aligning the rates. If you align your rates, then a lot of this effectively disappears. But there is a pretty strong attack here. There are multiple different types of share option schemes and indeed approved share schemes out there which offer a variety of either income tax reliefs or capital gains reliefs at the moment. This report effectively looks at them all and says none of these really are an incentive to share ownership. None of these complex rules really affect people's behaviour or the amount of time that they hold their shares. In particular, it talks about save as you earn schemes, which are often run by large PLCs. They're an all-employee share scheme where people can buy shares in the likes of Tesco or whatever. But it makes the point that the vast majority of people sell their shares almost the instant their eligibility becomes on a tax-free basis. So they look at all of these share schemes and basically, throw caution to the wind and say, well, none of these work for the incentive. So should really any of these, is the line they're going along, be under capital gains rules? And that would be an absolutely massive change to the way share schemes work in the future. Of even more worry, and again, I stress this is the one where they don't align the rates, is the further attack on private companies. And it gives an example, which I'll spend a bit of time on, but in essence, what they're looking at here, those people who have accumulated reserves in their private limited company over a period of time, when they come to sell that company at the moment, they qualify hopefully for business asset disposal relief and pay capital gains on that. And this report is looking at that and saying, well, is that really right? And they point to the fact that there is a lot of individual choice here as to whether or not things are accumulated or not. So these are the key points they have in their report. They say if an individual sets up a company through which to trade, the net profit after corporation tax has been paid can either be distributed as dividends or accumulated as retained earnings. Dividends are subject to income tax, which, as I'm sure you know, the higher rate for that is as high as 38%. Earnings which are retained in the company are not subject to income tax on the owner. Well, that's because they're not earnings of the owner, unless they are paid out by way of distribution prior to the winding up or sale of a company. The value of any retained earnings remaining within the company at the time of a winding up or a sale of the company will form part of the value of the final distribution or sale proceeds, and makes the point that, you know, the tax can be as low as 10%. So quite clearly they're taking aim here at the thing that everyone looks to do, which is retain as much as possible within their limited company, not to suffer income tax unless it's absolutely necessary, and accumulate that within the company as long as possible. And they say, well, maybe you shouldn't be able to do that. Maybe there should be, and it comes up with a couple of suggestions how to deal with this, either an additional corporation tax charge for retained earnings. You have to go back a long way in time. So we had a similar bit of legislation in the I think it was early to mid 80s, which was called close company apportionment. Be one or two people on this call that remember this, but in essence, it was a negotiation really with the revenue as to what was a reasonable amount of profit to leave in the company, and if you didn't extract your by dividend above that limit, then there was effectively a notional dividend charge. And it's talking about going back to that sort of scenario. Well, worse than that, it's saying, well, when you get to the point of sale, there's some sort of calculation that works out what is a reasonable amount of retained profits within the company, and that's fine. You can have capital gains tax on that, but anything over and above that would be charged to income tax. And it also talks about potentially eliminating business asset disposal relief on liquidation. So if you traded for many years, successfully accumulated reserves over that period of time, and then you decided to hang up your boots, so to speak, and move on, at the moment you get the 10% or 20% rate of capital gains tax. The suggestion is that that shouldn't happen, that should be charged to income tax instead, which would again be a pretty fundamental change. I often wonder when the way they write these reports, they're trying to lead one way or make it sound so terrible that there's only one choice here. None of this happens if they align the rates with income tax. And I think that, you know, the overall impression of this report is moving in that direction and making everything else in the report sound so terrible that you will actually welcome the alignment of rates with income tax. I think that's unlikely, but I think that is how the report is intended. So that deals with all the sort of boundary issue points. Moving on then, there's a couple of recommendations about the annual exemption. And this is an interesting point, really. It says the government's policy is that the annual exempt amount is intended mainly to operate as an administrative de minimis that you consider reducing its level. What does all that mean? What it means is there is a level of annual exemption at which it simply isn't worth the revenue trying to tax people, because for the amount of revenue they get in compared to the extra work they have to do and their computer systems, etc., it becomes not worthwhile. Quite clearly, they do not think the current level is anywhere near that. Why do they think that? Well, we've got a little graph here that shows you, Charlotte, if you just move on to the next slide. This shows the distribution of gains for the 27-18 year between 0 and 15,000. So everyone who reported a gain between 0 and 15,000. And as you can see, there's a little bit of a spike around the 11,300 level, which coincidentally was the annual exemption for that year. where it shoots up to quite a significant number of taxpayers around that period of time, and then drops immediately back down the other side of the curve. Now, it shouldn't be a massive surprise to anyone. Why? Because if you've got a significant share portfolio, you've got a stockbroker in tow, generally speaking, they will automatically do this at the end of each tax year. They will, cash in some gains, etc., which will use up your annual exemption and thus increase your base cost and reduce future capital gains when you really do want to sell the assets in the future. So quite clearly, people will make very good use of annual exemptions. It's a generous figure at the moment, 12,300, and obviously a husband and wife situation, that's almost 25,000 of gains that can be exempt each year is significant. So they're taking aim at the amount, and they say, well, if it was less, you can see on the slide there, if they dropped it, say, to £5,000 instead, it's estimated that that would double the number of taxpayers that have to report gains. If they dropped it as low as 1,000, then perhaps 3 times as many would actually have to report gains. It does say in the report, its recommendation really is in the 2,000 to 4,000 category, but there are some additional complications that do come from that, and they have to weigh up the additional tax revenue compared to the additional interactions with the taxpayer and problems there are reporting those gains. At the moment, the exemption has 2 uses really. You don't have to show on your tax return at all any capital gain which is under the exemption, as long as the proceeds is less than 4 times the exemption. If we drop the exemption, say, to 4,000, then that's going to bring in a huge number of transactions, some of which perhaps don't even end up being chargeable to capital gains tax at all. So they've got to weigh up the odds here. In order to bring the exemption down, they are saying they would effectively have to increase some exemptions elsewhere. And they talk in the report about the chattel exemption, which on its own I could probably talk for an hour about, but in essence, chattels are personal possessions. There's 2 types of chattel. There's things called a wasting chattel, which is something that has a life less than 50 years, or intended to have a life less than 50 years. They are generally exempt from capital gains tax, and if it's something that can last more than 50 years, then generally it is chargeable to capital gains tax. And there's a suggestion there would have to be some tinkering with the rules there to stop multiple transactions being brought in at a lower level if they do drop the annual exemption. They also say that real-time capital gains tax reporting would be more useful to taxpayers. I'm not quite sure what the connection with the annual exemption is, but that's what they write in the report. At the moment, as I'm sure you know from last year, you've had to report sales of residential property in a real-time basis. So residential property, there's a separate form that you have to fill out within 30 days of disposal. The suggestion that perhaps more assets get brought into that scenario is a bit of a worry. It does make the point that the admin at the moment is, they don't use this word, but it is hopeless. At the moment, you have to report on a special form within 30 days, and then you have to report it again on your tax return as if you hadn't already reported it, because the 2 things they're just not linked on the tax system at the moment. That's something that they would have to deal with. They also say, in terms of the sort of complications of reporting, we can perhaps rely more on technology these days and require perhaps stockbrokers to notify capital gains direct into your tax account and recommend payments of capital gains tax, which would be interesting. I think those sort of things are generally easy if you've got one stockbroker. It's less easy if you've got multiple stockbrokers who wouldn't necessarily know what the other one was doing. So I can see all sorts of issues there. And the other suggestion in there is to have some sort of tapering on the exemption in the same way that there is for the personal allowance, that perhaps once you get to a certain level of gain, that you start to lose your annual exemption. So if you had gains of over 100,000, say, then perhaps you don't get an annual exemption at all. So those are all of the things that they've thrown into the report under the annual exemptions. I think one thing's almost certain is it's not going to stay at the level it is at the moment. And that's something that people have got to make good use of in the meantime, whether it goes in the next budget or the one after. There are still a large number of people who don't make good use of the annual exemption each year, and it's something that, you know, should be routine, especially if you've got any form of stocks or shares, anything like that. Then making use of these exemptions is absolutely key. It's a valuable relief at the moment, which may well be on the way out. That's the annual exemption. I think I strayed into slide 6 there as well, actually. So if we can move on to the next one, please, Charlotte, that'd be great. The next 3 recommendations all centre around, in reality, the interaction of capital gains tax on death and how that interlinks with inheritance tax. And there's some pretty controversial stuff in here, really. Sorry, can you just go back to the previous slide, Charlotte, please? This highlights the situation that I think the revenue dislikes. If you look on the left-hand side of the screen, it shows a situation where, on death, assets can pass from an owner either to spouse or other family members with both no inheritance tax and no capital gains tax. So these are generally assets that attract business property relief, or if they go to the spouse, so under the spousal exemption, you get an uplift currently for all your assets on death. So there's no inheritance tax and no capital gains tax. You contrast that to a situation where lifetime giving is desired. You might have a second home, say, that you want to give to your children. If you gift that during lifetime, you can end up with both taxes. So you can have capital gains tax on a lifetime transfer, even if it's a gift. And then if you're unlucky enough not to last 7 years or a similar period, then potentially there's inheritance tax there as well. So that's what they're looking at and saying, well, that manifestly is not right. They say it's not fair. Guess which way they're coming at it from. Is it the increase it all so there's no tax, or is it the other way around? Well, not surprisingly, it's the other way around, of course. And Charlotte, you can go on to the next slide now. The recommendation is pretty clear here. Where relief or exemption from inheritance tax applies, the government should consider removing the capital gains uplift on death and instead provide that the recipient is treated as acquiring the assets at the historic base cost. It is absolutely fundamental. You know, people have, in some cases, plan all their life in terms of the way they're going to pass on their estate, knowing that there is this exemption from capital gains tax on death, and it appears to be very much under threat. Now, it's not that there would be necessarily a charge to capital gains tax on death, although the report does consider that there should be a charge on death and inheritance tax. It sort of loosely dismisses that. But instead, whatever the base cost of the owner, the person who dies, effectively becomes the base cost of who it passes to. That is in reality, and in a lot of cases, the same as charging assets to both inheritance tax and capital gains tax, because in a lot of situations, assets pass under a will and then the recipient sells that asset. So it could be a situation where potentially there is a double whammy. They talk in recommendation 7 about this only applying to assets where there has been no inheritance tax. And you think, okay, well, I can understand that logic. But they barely take a breath before recommendation 8 comes in and they say, actually, while we're at it, why don't we just abolish it completely? is effectively what recommendation 8 is saying. In addition, the government should consider removing the capital gains uplift on death more widely and instead provide that the person inheriting the asset is treated as acquiring the assets at historic base cost. That would be a real game changer, obviously, you know, and every estate that have been planned over the last 10 years or so, you'd have to go back and look at the situation, because we are often advise clients on pre-death planning, well, you shouldn't move this asset because there's going to be a big uplift in the base costs, and that's going to be benefit for everyone in the future. And that really, if that's taken off the table, then it fundamentally changes the way people look at their estates, how they plan, whether they're going to do lifetime giving or giving on death. At the moment, the figures show that approximately 90% of all wealth transfers on death. And there's why? Because it's free capital gains tax. It's as simple as that. If you take that away, that fundamentally rewrites the rules. So that is significant and something to be very wary of. However, it does go on to say and give a little bit of good news to temper what is a fundamental change. And it says, if we do remove the capital gains, this is the third recommendation in which they said, if we do, meaning that we think you should. If you remove the uplift on death, you should consider at the same time rebasing all assets, and it uses the year 2000 as an example in the report, and the reason it came up with that particular date, one of the issues always when dealing with estates and capital gains tax and inheritance tax is trying to find the history of the asset that's being disposed of, because the person who owned it's no longer with you. Picking up their records, they may be good, they may not be good, and there's all these sort of issues and uncertainty. So they say if we rebase all assets to 2000, and that effectively rewrites capital gains tax as starting from the year 2000, then that's going to make the record keeping so much easier for everyone. That is the date at which most valuers would say there is enough electronic records to be able to go back and gather original costs, etc. And most stockbrokers would have had good computer systems from that period of time. So there's some logic to the date, but it is a fundamental change to the existing capital gains rules. At the moment, obviously, the earliest capital gains date is 1982. We could have a situation now potentially, because we don't know for certain when that date is going to be, or if indeed there is going to be a rebasing. When looking at planning, you have to consider potentially the original cost of an asset, what the value was in 1982, what a hypothetical value is in the year 2000, and try and work out what it is valued today, to even think about what all of the possibilities are when it comes to estate planning. So this really does cause a lot of complications, and if that is a path they're going to go down, then they need to be pretty rapid in making that rule change, because it's adding complication, and it makes it actually more difficult to plan, I think, than it is currently. In addition to that, which is still a good thing, obviously, because it's going to eliminate a lot of capital gains, consider extending gift holder relief to a broader range of assets. Now, this would be very significant, and this is in conjunction with effectively, if we align the rates with income tax and we drop the annual exemption, that this is something that should also be considered. At the moment, you can make gifts of business assets between individuals, and you can hold over the gain. Up until 1979, you could do that on any asset. You'd gift assets between family members, and you could hold over the capital gain between you. And what happened was, people prior to a disposal, they would carve up the asset and gift a little bit to every member of their family, so they could all use up their annual exemption. And that's one of the main reasons that gift relief was abolished. but it makes the point in the report that if they're going to drop the annual exemption to a relatively modest level, that sort of behaviour probably wouldn't be an issue, and therefore they can bring back in this potential gift relief. This would allow wealth, to cascade down the family generations without potentially ever paying capital gains tax. You can't do that at the moment with certain assets. So again, this would really help with the lifetime giving. If we're going to abolish the uplift on death, and I guess they want to make it a little bit easier to move the assets in lifetime. So there's something that's positive in all of this. And the last two recommendations centre on what most people still refer to as entrepreneurs relief. The reality is entrepreneurs relief was abolished a couple of years ago. It's now called business asset disposal relief. The rules are exactly the same. It's just the limits that have changed over that period of time. And again, they've taken a massive swipe at this and its usefulness. It spends a good number of pages talking about whether or not there's any real incentive to investment and whether it encourages people, to run private companies and take risk, etc., and comes to the firm conclusion that none of those things are true. And it thinks it's too generous a relief in reality. That's the bottom line in the report. The recommendations that it makes is like going back in time to the days of retirement relief, because its recommendation is, first of all, that the 5% shareholding is too small, and in actual fact it causes problems for people, because if it gives an example, if you wanted to get rid of a board member who's a 5% shareholder, it's pretty difficult to do because they want to hang on and get their lower rate of capital gains tax. So the suggestion is that the 5% minimum becomes a 25% minimum, which is obviously a substantial change. The 1 and 2 year holding periods become 10 years again, which is what it was when it was first introduced. And an age limit is introduced, which it doesn't use the word retirement relief, but it says should be linked to perhaps the personal pension retirement ages. And lo and behold, you've pretty much got the legislation that was in place in the late 90s called retirement relief, which required you to have a minimum 25% shareholding, which accrued over a 10-year period of time and was eligible originally at age 60, although that was dropped to 50 after a while. And I think the business asset disposal relief, as we know it at the moment, is almost certainly going to go. Whether there'll be a major effect for most private companies, not sure, because a lot of people will have held their private companies or traded them for that 10-year period of time. But it will stop the quick in and out situations where people build up a company and sell after a couple of years. Potentially, you're putting people that would be paying 20% capital gains tax currently and lower on the first million into a 45% tax rate if they're aligned with income tax. So that's what they're taking aim at. That it goes. It's pretty clear in the report. There's no positive spin on it whatsoever. And it talks then about investors relief. Investors relief was actually only introduced in 2016. It mirrors more or less the rules of business asset disposal relief, but it's for people who don't work in the company, who had subscribed for shares directly from the company. And they simply make the point that virtually no one's claimed it, so we're going to bin it while we're doing all of these changes. That will go as well. So the entrepreneurs relief, as most people still refer to it as, substantial change coming there, much more likely to end up with a retirement relief type situation, probably going to have some sort of age limit on claiming that lower rate. And that's really the summary of the main items of the report. There is, as I said, there is intended to be a second report issued, which generally speaking, the second report goes into much more technical detail about the type of legislation that could be introduced. And obviously, as soon as that comes out, we'll give further guidance. But I would expect something in the next budget. Whether there would be the dramatic change that is suggested in this report all in one go, I'm not sure, but I think it definitely is coming over the next couple of years. And were it not for the fact that, you know, the pandemic over the last 18 months, I think we'd probably already have it. So at this point, I think it's time to throw it open to questions.
Thank you very much, John. So we've actually had a couple of questions in the meeting chat. So the first one's from Mike Taylor, and it's investment company concerns in the report.
Yeah.
Is there any expectation of real tax leakage avoidance, or is it really about deferring tax? Unless I'm missing something, this is really the only impact of an investment company structure, isn't it?
Yeah, I think that's right. The report centres really on what happens if we change the current rates of capital gains tax to align with income tax. That there is a big differential then between the rate of tax at which a gain might be taxed. If you're in a corporate situation, you've got £100,000 gain, you're going to pay 19% today, possibly 25% in a couple of years' time. Compare that to being a higher rate taxpayer where you could be paying 45%. But of course, the money is retained within that company. Generally, we find these family investment companies are set up when there are control issues within the family. So, you know, mum and dad might want to involve adult children in the sharing of wealth, but they don't particularly want to give them control of the asset to do as they please. So there are other issues at play as well. But generally, these are looked at from an income tax saving point of view, sharing out income amongst the family for those to use up basic rate bands, etc. The biggest differential will come if they change the way the rate of capital gains tax applies. So yeah, I think you have that right.
And we have another sort of comment and question from Mike. So BADR/entrepreneur relief.
Yeah.
Any expectation that might loosen rules around EIS? Currently, founders with decent shareholders cannot benefit from these schemes, but do get the 10 to 20%. But if that goes, then ironically, passive rich investors get a better deal than a founder.
Yeah, I think it's a pretty good summary. There's no mention of EIS, or virtually no mention at all in the report. The only time in which it comes up, and they talk about the loss on shares. So, you know, you take EIS loss relief as an example. It's one of the few capital loss reliefs that can be set against income, but there's no talk whatsoever about changing the rules or the requirements. Whether that would naturally happen if they're going to change the business asset disposal relief to 25%, maybe it's something they will look at. But it's not really dealt with in this report. Perhaps there'll be further mention in the second report.
So they're both the questions that we've had. If anyone else has anything else they'd like to ask, feel free to either raise your hand or pop your question in the chat. We've just got a couple of minutes left, and then obviously the webinar will be closed. So if anyone else has any more questions.
I never know if that's good or bad.
No, I think that's it, John.
One thing I would say, often people have questions immediately. They leave the seminar or webinar. That's fine. Just email me or send me a message. That's fine. I'll try and deal with those. It is a lot to take in. We understand that. And I think over the course of the next few months, you know, where we think clients have got relevant issues, we will be in contact to discuss your affairs.
We have just had a question from Pamboss.
Yeah.
Is it worth considering estates now or to wait?
Oh wow, that is the $1 million question, isn't it? I think the answer is you should look at it now. I'm not sure you would come necessarily to conclusion now, because, you know, to try and draw a flow chart as to what you should do when would be exceptionally difficult. Everyone's got unique circumstances, but I think we could highlight the areas which are there for potential change, and then it becomes, you know, how lucky do you feel about the rules changing over the year ahead? One of the biggest issue to me, I think, is the rebasing date. That is absolutely fundamental to all forms of both inheritance tax and capital gains planning, because if you were setting up transactions now, perhaps using transfers into trust or to other family members, and you're locking in a gain based on 82 values, and if you waited a year or so, perhaps that's going to be based on 2000 values. That would be a significant factor, I think, in any planning. You know, and there may be some that go the other way. You know, there could be assets that were of higher value prior to 2000, and a rebasing to 2000 could potentially hurt some people as well. So I think, to my mind, yes, it's worth spending the time taking a step back and just saying, well, under my current plans are this. What would happen if the rules don't change? What would happen if the rules do change? And see what that throws up.
Well, thank you very much, everyone, for joining us on the webinar. We have got another webinar on the 24th of June, which is Employee Ownership Trusts. And we'll also be sending you just a thank you email this afternoon with a short survey. So it would be great to get your feedback on this webinar. Obviously, we'd like to find out if there's any other days or times that would be better, how you sort of rate the content. So the feedback would be greatly appreciated. So if you wouldn't mind taking a couple of minutes just to complete, that would be great. Other than that, we hope you have a lovely day, and we hope to see you soon. Thank you very much.
Thanks, guys.
Thank you.
Thanks all.
Thank you.